Ben Bernanke was the chairman of the Federal Reserve from 2006 to during his tenure. He faced the global financial crisis of 2008 and the Great Recession that followed. To combat the economic downturn, he implemented an unprecedented monetary policy that involved cutting interest rates to near zero and buying trillions of dollars of bonds and mortgage-backed securities. This policy was known as quantitative easing or QE. The main goal of QE was to lower long-term interest rates and stimulate borrowing and spending. By increasing the money supply and creating demand for bonds, QE was supposed to boost economic growth and inflation. However, QE also had some unintended consequences that have haunted the economy ever since. One of these consequences was high inflation. By flooding the market with money, QE reduced the value of the dollar and increased the prices of goods and services. This eroded the purchasing power of consumers and savers, especially those on fixed incomes. High inflation also distorted the signals of the market and created asset bubbles in stocks, real estate, and commodities. Another consequence was low interest rates. By keeping interest rates artificially low for a long time, QE discouraged saving and encouraged excessive risk-taking and debt accumulation. Low interest rates also penalized productive investment and rewarded speculative activity. Low interest rates also made it harder for the Fed to normalize its policy and exit QE without disrupting the financial markets and the economy. In summary, Ben Bernanke's monetary policy led to high inflation and low interest rates that have harmed the economy in many ways. His policy was based on flawed assumptions and failed to achieve its intended objectives. Instead of stimulating growth and inflation, QE created instability and uncertainty that have undermined the long-term prospects of the economy. Inflation is the general increase in the prices of goods and services over time. It reduces the purchasing power of money and erodes the value of savings and investments. Inflation also impacts the competitiveness, productivity, and growth of the economy in various ways. First, inflation affects the relative prices of different goods and services, which can distort the allocation of resources and create inefficiencies in production and consumption. For example, if inflation is higher in one sector than another, it can make the goods and services in that sector more expensive relative to others, and reduce the demand and profitability of that sector. This can lead to a misallocation of resources away from the more productive and efficient sectors, and lower the overall output and welfare of the economy. Second, inflation affects the international competitiveness of a country's exports and imports, which can affect its trade balance and foreign exchange reserves. For example, if inflation is higher in one country than its trading partners, it can make its exports less competitive and its imports more expensive, leading to a trade deficit and a depreciation of its currency. This can reduce the income and wealth of the country and make it more vulnerable to external shocks and financial crises. Third, inflation affects the expectations and behavior of economic agents, such as consumers, producers, workers, and investors, which can influence their decisions and actions. For example, if inflation is high and unpredictable, it can create uncertainty and confusion about the future prices and incomes, and reduce the confidence and trust in the economy. This can lower the consumption and investment spending, and increase the precautionary saving and hoarding of money. This can also reduce the incentives for innovation and entrepreneurship, and increase the demand for wage and price adjustments. These effects can reduce the aggregate demand and supply of the economy, and create a vicious cycle of low growth and high inflation. Therefore, inflation can have significant negative effects on the competitiveness, productivity, and growth of the economy, especially if it is high and volatile. This is why central banks like the Federal Reserve try to maintain a low and stable inflation rate as one of their main objectives. However, as we will see in the next section, Ben Bernanke's failure to control inflation during his tenure as the Fed chairman has created many problems for the U.S. economy that will haunt it for years to come.